You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of The Options Playbook. Well, most of the time on Options Playbook Radio, we'll look back at our trade from the week before, and the earnings season isn't 100% done. So we talked about Dollar General, and we've done... Well, let me put it this way. The topics have been fairly advanced leading into last week's Options Playbook Radio episode. And so we just decided to do something fairly simple. We just did a long call spread, 100% speculation on the earnings of Dollar General. Now, we're taping Options Playbook Radio, and it is the 26th of August. It's a Wednesday. The markets are closed. And since we did the call last week, we were bullish on the stock. Now, remember, whenever we talk about bullish or bearishness, it's not meant to be a recommendation. We're just trying to learn here on Options Playbook Radio. But we did a long call spread, and we straddled the stock. The stock was at $200. We bought the 195 call, and we sold the 2005 call, and we had the August 28th expiration. Now, Dollar General is supposed to announce earnings tomorrow before the open on the 27th. So that means you have 2 full days after the announcement for these option contracts to trade before they expire. And we talked a lot about time premium. And the main reason why I want to bring up Dollar General and let this be a lesson to you about long spreads in that when you're doing a long spread, even though you're bullish on the underlying stock, you are still battling a bearish trade. In other words, you're selling a call option contract that is out of the money, that wants the market to go down or at least stay the same, right? And you are buying an option contract, in our instance, that was in the money, that wants the market to go up without a doubt. So the reason why I bring this up and why this is interesting, and I hope that you did it as a paper trade to follow the pricing, is that last week on Wednesday when we talked about Dollar General, we looked at that long call spread, 10 points wide, centered around where the underlying stock was at. At that point in time, the midpoint of that trade was $5.40. And you can go back and listen to last week's show if you want to get a little bit more detail. But we had Dollar General has basically gone up since we said that. Maybe they had a couple of flat days, but no real down days. And right now we see Dollar General trading on the close on this Wednesday at 204.09. It ended up up $5.43 on the day. Well, our short strike is the 205 strike. So that is the most at the money strike right now. And so we have a pending earnings report. We had the stock run all the way up to our short strike already. Usually when we're doing earnings trade, we would put it on tonight, or basically close to the close before the earnings. But on Options Playbook Radio, we don't always have the luxury of picking the exact day that we're going to talk about it. But the biggest thing that I want to bring up is right now it's trading at the midpoint at $5.95. So this trade is actually only made 55 cents, even though the underlying stock has made a strong move to the upside, and it's up approximately 4 points since we talked about the trade. And so what happened here? Well, as I mentioned, we need that short option to go to zero. So first of all, we're going into earnings, so implied volatility is increased on the underlying. Usually it will increase all the way up until earnings and then drops off after. Now, that's usual case, not always 100% the case, but that's usually what will happen. And so we had the implied volatility increase on our short option and on our long option, but more than anything, it became an at-the-money option contract. And that has the most juice out of all the option contracts. So in order to really get paid on this, we would have had to get fairly deep in the money to make a decent amount on our trade. Now, I don't want to look a gift horse in the mouth. You're still up 55 cents on the trade, and I'd rather pay $5.40 for it than $5.95. But this just shows you how long spreads can sometimes be tough. If we would have just bought the call outright, we would have done we would have had a real decent return overall. So comparatively, if we had just bought the 195 call, we would have had to pay up for it. But yeah, we would have done very well on the 195 call. But we were going to do this going into earnings. It was an earnings trade, so it made sense to do the long spread. Didn't really think that Dollar General would make a 5-point move here on the day before earnings and have that big upside move and get up to our short strike, but it did. And it's a real interesting lesson on how long spreads can sometimes be tough. And that's why we would want to do something where we think implied volatilities are going to go down on that short option contract that we're trading. So two things can happen. You got to be very choosy on the expiration that you're picking when you're doing long spreads. And then obviously, if we have an earnings announcement, you would expect implied volatilities to go down, but you still need the stock to go in the right direction overall. So interesting scenario in Dollar General. But today I would like to talk about stock splits. We have two big players in the marketplace that are going to be splitting their stock. Apple is going to be splitting this Monday, and also Tesla is going to be splitting this Monday, which is the 31st of August. So both stocks have had record highs. They've set record highs this week. And I'm going to focus on Apple in general, mainly because Tesla is such an expensive stock. It's fairly hard to talk about. And I do think overall more people have more exposure to Apple. But my concepts that I'm going to talk about, you can apply to any stock that might have a big run-up going after an announced split or even after earnings. And Apple and Tesla have both definitely had good runs. Tesla has been insane, basically parabolic to the upside, and Apple has done extremely well. They've both, during the age of the pandemic, have led the markets higher. So a lot of times when people are thinking about options as protection, they don't like to think about buying placing a protective strategy when they first buy the underlying stock. And why is that? Well, you bought the stock because you think the market's going to go up. But this is a scenario where I think it would be more interesting to consider buying a protective put. We've had a huge run up in both stocks. And I'm sure many of you out there have heard the phrase, buy the rumor, sell the news, right? So in this instance, it doesn't 100% apply, but where a lot of people have rushed to buy before the split, and there's a little bit of nervousness in the marketplace that after the split, the news event will happen and the frenzy will be over. Now, with Tesla, there's no rhyme or reason why it's doing what the fundamentals of the company don't really support the stock price, and I'll just leave it at that. Apple, you can kind of make the argument. Apple has obviously a lot of cash in their bank account, and on top of it, they have very solid earnings across the board. So they're two different type companies. But if I look at Apple, and I know they're going to be splitting on Monday, and I'm a little bit worried that on Monday, it might give back some of the rush that it's had going into the split over the last couple of weeks. I may buy a protected put that gives me that expiration going out until September 4th, which is that Friday. Now, all I'm trying to do is get through the actual event and see what happens with Apple. So if I were just buying a protective put and I look at that September contract, I can see that September contract right now is trading on the bid. Now, remember, the markets are closed. We're looking at the 500 strike put option. We have Apple closed today at 506.09, 506.09. $506.09. It was up $6.79 on the day. And that 9-day 500 strike put is trading for $13.65 on the bid and $14.10 on the ask. Now, unless I don't know where you could have bought Apple over the last year and have a losing price on it. I don't even know if that's feasible, especially if you bought it a couple of years back overall. So the odds are that if you own 100 shares of Apple, that you probably have a decent gain on it. So why not protect that gain a little bit? That's the concept. That's what options were first intended to do. Options came around because of a need to protect an asset, not necessarily as a need for speculation. And that's why you hear so many terms in the insurance world that are also used in the option contracts. Example, what do you call the price of an option contract? You call it the premium. When you sell an option contract, you are referred to as the writer of the contract. When you buy car insurance, the person that sells it to you is the underwriter of the policy. So there are just a lot of terms that come from the insurance world that are actually in the options world. So instead of speculating, why don't we use this opportunity to buy a protective put in Apple? If we pay $14 for it, like I said, it's $13.65 by $14.10. I'm going to not quite pick the exact midpoint. We'll say we can get a little bit of a favorable fill at $14. No guarantee there. But now I am spending 2.8% to protect my downside in Apple. Now, I had a big run up on Apple today, went up $6 already. So you do have a deductible. So your total risk, if you pay that $14, just like if you bought car insurance, right? If you bought car insurance and you drove your car into the tree, do they say, oh, you are right, you're a horrible driver. Here is your new car and your policy premium that you paid for it. No, that's not the case, right? The premium is a cost of doing business, but they'll give you a new car for it. So in this instance, we have a deductible. That deductible would be the difference from where the stock is at right now to where the strike price is. So from 506 and some change down to 500, that's 6 points. We're paying $14 for it. Our total risk here would be around 20 points. So going into their stock split after this big run up, that would be about 4% of the stock price. So if you're thinking about a time where you might want to use a protective put, I'm going to have 4% risk by paying 2.8% of the dollars on my 100 shares of Apple to protect myself after a frothy run-up going into a 4-for-1 stock split in the underlying. So, interesting enough. Now, if you still say, well, that's too much. 2.8% is too much. Well, another aspect to look at would be, well, maybe I sell a call with the same expiration to try to pay for it. But now you might say, well, gee, it is going to split. And there means that the main reason even Apple said it on their investor services page is to make the underlying stock more, quote unquote, affordable or easier for retail investors to buy 100 shares of it. And that's their main rationale in doing it. They're also a component of the Dow, and the Dow is a price weighted index. And because of that, they make up a big part of the Dow, and so if they split their stock, they're more in the middle of the pack, right? And they're not so representative of the Dow Jones Industrial Average. So there's a couple reasons why Apple might want to split their stock right there, and they've kind of highlighted some of them on their investor services page. Okay, so if you're a little nervous, though, that the underlying stock might go up, and I'm thinking about selling that call option to help pay for my put option, well, that's a viable strategy. Now, we're assuming, and I just want to make it 100% clear, that we own 100 shares of Apple already, right? We're not buying Apple. We're not going to do it right now and then buy the protected put. We're saying we've owned Apple. We got a decent gain on it of maybe 100, 150 points, even 50 points or whatever, depending on where you bought it at. So we probably have a gain on Apple overall. It's at an all-time high. So why not buy a little bit of protection going into the split? And if we sell a call against it, then that's considered a caller. So we have a protected put, long 100 shares, and look at selling a call. What call would I sell? Well, I'd like to pay for my put, but in order to do that, I would have to sell the 515 strike call, which is only about 9 points away from where the underlying stock is at. That call is actually doesn't even cover the whole price. It would be $13.30 by $13.50. So I'd probably want to go further out of the money. And so how far would I want to go out of the money? Where do I feel comfortable on this specific trade overall? Well, I'm going to start by just looking at, well, what's the expected move? A lot of people look at expected moves going into earnings to try to pick strike prices. So why not do it going into the split? If we look at that September 4th expiration and we buy the 505 call and the 505 put, we're seeing that's trading for about $33. Now, remember, expected move has no regard to direction. It's saying that's the line in the sand. That's the over-under, if you will, by what the marketplace sees a potential move could be in Apple after the split. So $33, well, let's go at least that far out of the money. And if I look at this, I look at the 550 strike. So we were talking about the 515 strike. Now we're going to talk about the $550 strike. And we see that's trading for $535 on the bid, $540 on the ask. Maybe I can sell that. And now I bring in that cash, and I go from $14. I bring in, let's say, we'll say $535, which is the bid price. So I bring in that $5.35. I lower my cost down below $9 for buying that put outright. But now I'm limiting my upside. But that upside potential is higher than what the expected move would be. So it would be a fairly massive move in Apple, but it could do that. Okay. So what's another way to do this? Well, if you buy the protected put, and let's say we did it tonight, why not shop the 550? Why not put a limit order in and say, well, you know what? If Apple does make a move up going into Monday's split, you got all day Thursday, all day Friday. Why don't I try to sell it for $10? See if the market moves up to that. Now I'm getting a massive chunk out of Apple going into that split, and I might be a little bit more apt to sell that call option. I got the protection on. I bought the put already. Why not shop a call further out of the money? You pick. You pick how far out, and you pick a price and just see if it gets filled before you get into the actual event. on the 31st of the 4-for-1 split. So it's just an interesting way to approach the trade. If you're still a little nervous and you're still really bullish on Apple, you think after the split that it will accomplish its goal and you'll have a lot of retail investors coming in and buying 100-share lots at the 4-for-1 split price. Well, then you just buy the protected put. You just spend about almost 3% to protect your $50,000 investment. If you own 100 shares of it right now, 100 shares of Apple at would be $50,909 based off of the closing price. So I'm going to spend $1,400 to protect my $50,609 investment, and I'm just going to do it going into the 4-for-1 split on this Monday. Now, let's talk about Tesla. Tesla is just a different beast overall. That's because Tesla closed today, had a big update also, and it closed at $2,153.17. It was up $129.83. And Tesla does not trade at the implied volatility that Apple does. So if you just wanted to buy a few points out of the money, let's just look at the most at-the-money strike in Tesla. The 2,150 strike put option is trading for over $100. Right? It's 101.30 on the bid and 109.80 on the ask. So that's a little bit harder. That's a little bit harder to stomach if you wanted to just buy a protected put outright on Tesla. But a collar is feasible. If the put is that expensive, the call would be also that expensive. So you could look at buying a put. We're looking at the most at-the-money vol for that same September expiration, which is 9 days away. If you look at buying that at-the-money put, it's trading at about an 80% implied volatility, so fairly hefty implied volatility overall. And to sell, if I go all the way up to the 2,175 strike, I see on the call side, that's trading 93.80 by 101. So the bid-ask spreads, the width of them are artificially wide right now because the market's closed. But you could think about doing this in Tesla. Now, if you do this and you have a big gain and you don't want to sell that underlying stock, you just be prepared to roll it or buy it back or do something to try to avoid that assignment, but you're buying some protection going into this stock split. And it's and once again, Tesla has just gone to the moon since they've announced their split a couple of weeks back. So overall, I think now is the time to think about buying some protection in some of these underlyings that have had really big moves up. We have a specific event that we're targeting, and Apple is a little bit more feasible than Tesla just because of the overall cost of the underlying stock. Whenever you look at a stock, just like in the insurance world, we've made that analogies a lot. It's going to cost you a lot more if you think of car insurance to insure your Bentley than it is your Chevy Cavalier, right? Just because of the pure cost of that underlying asset that you're insuring. So it's going to cost you more to insure a $2,150 stock versus a $506 stock overall. And then you throw in the volatility of the Tesla and that stock overall, and those options are expensive. So that's going to be it for this episode of Options Playbook Radio. Be interesting to actually do a poll to try to figure out, well, where do you think that Apple and Tesla will go up on the close Monday or be down on the close Monday? I would like to see that from our listeners out here on Options Playbook Radio. I think that would be a real fun little thing to see how many people think that these stocks will close up on Monday after the split or close down on Monday after the split. If you have any questions, you can email me at theoptionsguy@invest.ally.com. And be cognizant of the strikes. If you own any calls, have sold any calls, after the split, you want to make sure that your strike is going to be an even number. You're not going to end up on a fraction, because if you get kind of an odd strike after the split, if you own options or if you've sold options, sometimes they'll become a little bit more illiquid just because people don't like to trade fractional. I don't need my Apple to be trading at 125.25 strike, right? So you can do the math on it, figure out where your strike is going to be at. You can email me if you have any questions on that. And you can also follow me on Twitter. My handle is Brian Overby. Thanks for coming. We'll see you at the same time, same place next week. Until then, may all the options you bought finish in the money and all the ones you've sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.